Suppose sold you sold some material to one of your customers, uh, sold material of 10,000 US dollar to a customer. Now that customer gave you a check of rupees 10,000 US dollar after some days. So you received a check of 10,000 US dollars after some days. Now what happens next? That you deposited that check. No, actually you did not deposit, but you give the check to one of your employee to deposit it into your bank. Now what happens next? That the check is lost by your employee. And that employee left the job out of fear. Okay, now this is a scenario that you received your check from your customer, then you gave it to one of your employees and asked him to deposit it into your bank account. While on the way towards the bank, the check is lost by your employee, and that your employee leaves the job. And time passes just like that, days into days, days into months, and months into years, and you don't have your track of that check. So after quite some time, you remember that one of your customers gave you a check of rupees 10,000, but you don't have any clue whether you have deposited it into your bank account or not. You try to find the check, you try to find the um, any photocopy of the check or anything which can show you, which can assure you that you received the check from the customer. But after some time, it is not possible to track it down. The check entry is not into your bank statement. neither you have recorded it into your bank account journal. So here comes a technique, an accounting method which we use to track such kind of transactions, in which we identify any missing entry. Now here comes the concept of bank reconciliation. What we do first, that when we receive the check from our customer, we immediately record it into our general journal, make a voucher of it. What we do, record in our general journal. But the second thing we do, immediately make a photocopy of that check. The third step is that attach the copy with the voucher. Now, and afterwards, what we'll do, we give the check to one of our employees who deposit into our bank account. Now what happens here, that in case the check is lost by the employee, the check is stolen by someone from the employee, or the check is destroyed by any reason, or the check is, or the employee runs away with the check and don't come back to the company, we at least have a record of that check in our books of accounts. Or there may be a possibility that the employee reaches the bank and deposit it into your bank account, and after some time, after at the month end, you take the bank statement from your bank and that check does not appear there. So in any of these scenarios, what you do, you go back to your books of accounts, check the record of that check, then you take the bank statement which you have obtained from your bank, and then identify any missing check which you received from the customer but it does not appear in the bank statement. Then you mark that missing entry and write it on a paper to identify it separately. this paper is called bank reconciliation statement. So this is the this this is the main or basic theme of bank reconciliation statement, which is to identify any missing entry in the bank statement or in your books of accounts regarding a financial transaction.